continuing on with chapter 9, foreign exchange determination and intervention. In our last video, we discussed the theories trying to explain foreign exchange determination, right? If you recall, we discussed the three main approaches in explaining currency determination: the parity conditions, which we saw in chapter 5, balance of payment approach, which is the topic of chapter 3, and then we also introduced monetary and asset market approaches. Right? The main conclusion from that discussion is that none of these truly explains currency prices in the short term, right? So they all attempt to explain currency values, but none of them is truly one, let's say, great theory. That again, that's the main thing from that. The next topic we want to discuss is foreign exchange, foreign currency intervention, right? We have discussed foreign currency intervention here and there. We discussed that in chapter 3, for example. We discussed that in chapter 2 when we discussed the fixed versus floating exchange rates and so on. So we want to take another quick look at the government intervention in the currency markets, right? So foreign currency intervention is the active management, manipulation, or intervention in the market's valuation of a country's currency, right? So this is when a government takes steps to try to affect the value of its own currency in the market. There are many motivations to do that, including what we discussed in chapter 2, chapter 3, which is if a country has a fixed exchange rate, if the country has a peg exchange rate, then the country will intervene in the market to try to defend the fixed price of the currency. But in general, we argue that typically countries are going to try to affect the value of their own currency with two main motivations. These are mostly the basic domestic motivations. One is to fight inflation, and you want to do that by making your currency stronger, or you want to fight slow economic growth, and in the process you want to make your currency weaker, right? So that's kind of the rough link. Now we will again discuss this a little bit more, but in general there are three main ways for foreign currency intervention. One is the direct intervention. We also have indirect intervention, and we have the capital controls. So these are the three approaches. So let's see. Direct intervention is the active buying and selling of the domestic currency against foreign currencies. So for example, if the central bank of a country wants to increase the value of that country's currency, then the central bank will buy its own currency. Now, if you recall, we discussed this in chapter 2. So if you want to make your currency stronger, right? Either you want to make your country's currency stronger, or you simply try to defend the value of your country's currency. You don't want it to get any weaker. Then the strategy is you buy domestic currency. The central bank will buy domestic currency using its foreign exchange reserves. Typically, a lot of times the foreign exchange reserve is the US dollar, or you use your reserve of gold, typically. So if you are trying to make your currency stronger, then you are going to go into the foreign exchange market and you buy your own domestic currency using your supply of foreign exchange reserves or gold. Basically, you use gold or US dollars that you keep in your reserves to buy your own currency. Now, because you are trying to buy your own currency, right, the demand for domestic currency goes up. That, of course, the result is that the price of domestic currency will also go up. The value of domestic currency goes up. So pretty simple. Now the limit or the problem with this approach is how much of this you can do depends on your supply of foreign reserves and gold, right? So we discussed the case of when countries sometimes they have fixed exchange rates and they are trying to defend their currency, they will buy their domestic currency using their supply of foreign exchange reserves and gold. The problem, of course, is the supply of foreign exchange reserve and gold will decrease very quickly. And if that happens, you may not be able to sustain this strategy. And we saw examples of United States during the Bretton Woods era, for example. We saw the case of England before that, and so on and so on. Many, many examples of countries that simply eventually abandon this strategy once the foreign exchange reserves or gold supply basically depletes. In the other hand, if the country wants to decrease its currency value, then that country will sell the domestic currency, right? So the opposite is obviously true. So if you want to make your currency weaker, then the strategy is you sell domestic currency. So in this case, you are going to sell your domestic currency. In return, you receive foreign exchange reserves, for example. So you sell domestic currency and you receive US dollar, for example, the most common foreign exchange reserve, right? So in selling your own domestic currency, these will put pressure down on the value of the domestic currency, and typically as a result, the domestic currency will devaluate. The downside of this strategy is, well, theoretically, you can keep doing that. You can keep printing domestic currency and sell it. So you can keep printing your domestic currency and selling it. The downside is the result of that is the inflation will go up. So this strategy of trying to keep your domestic currency weak by selling it, the downside is it may result in very high inflation. And so you may find that your residents, right, domestic residents, may end up paying a very high price for that strategy in terms of high inflation. Now, in terms of how successful this strategy typically is, well, it will depend on the size of the country, the amount of the currency that is typically in the market. If your country is relatively small, the central bank may not have the resources to truly affect the value of the currency that well. So in that case, then you may need a coordinated intervention where you may have more than one country working at the same time to affect the value of a very specific currency. Another approach that you can use is the indirect intervention. Now, remember, with direct intervention, the central bank will specifically buy and sell domestic currency in trying to affect the value of domestic currency. With indirect intervention, you are trying to affect the value of your currency by instead changing some fundamental in the economy that will affect the value of the currency. So typically, if you want to increase the value of your currency, you typically want to increase the real interest rate in your economy. If you want to decrease the value of your currency, then you decrease the real interest rate. So with indirect intervention, with direct intervention, so typically what you see is that when domestic real interest rate goes up, right? When the domestic real interest rate goes up, this attracts foreign capital. Basically, foreigners want to invest in your country But because foreigners want to invest in your country, they need your currency. So this means that the demand for domestic currency goes up, right? In order for them to invest in your country, they will need to acquire your currency. And so this will result in the value of your currency going up. Goes up. So that is basically what we have in mind with indirect intervention meant to increase the value of the domestic currency. Now, just as what we discussed just a second ago, the downside of this strategy is when interest rates go up in the economy, right? This tends to slow the economy. And as a result, typically, you may see unemployment increase. So once again, in other words, your domestic citizens may end up paying a price for this strategy in practice. Now, if in the other end, you want to decrease the value of your currency, if you want to lower the value of your currency, then the strategy then is to lower real interest rate. So as a result of that, basically you may see capital outflow out of the country, right? So this leads to capital outflow out of the country. Basically, this country is not as attractive as an investment market, and that results in capital leaving the country and a drop in the domestic currency value. So pretty simple, you want to lower the value of your currency, then you lower the real interest rate in the economy. That in general will translate into capital outflow and a drop in the value of the domestic currency. The downside of this strategy, not surprisingly, is typically these results in inflation. So the downside is typically this will result in inflation. So once again, the domestic population may end up paying a price for this strategy. And finally, the third approach to foreign exchange intervention is the imposition of capital controls. And with capital controls, you simply impose the restrictions to foreign currency. Basically, you limit access to foreign currency, and that typically often will prevent capital both in and outflow from the country. And these will typically affect the value of the currency. So specifically, for example, suppose you are trying to prevent, you want to prevent the value of domestic currency from dropping, right? Suppose you are trying to prevent the value of domestic currency from dropping. One thing you can do with capital control is limit outflow from the country, right? Limit domestic currency outflow. So if the domestic currency is leaving the country outside, is going outside in search for better investment, typically this will result in the value of the domestic currency dropping. So let's say your country is a little bit unstable and investors don't want to invest domestically and they want to take their capital outside. These will typically result in a currency depreciation. Well, if you're trying to prevent that, one way to prevent it is to simply prevent capital from leaving the country. And you do that by limiting how easy it is for investors to acquire foreign currency. So these will limit the capital outflow and prevent the value of the currency, domestic currency, from dropping. Obviously, not surprisingly, many countries adopt capital control to try to protect the value of their currency. Now, in practice, these interventions do not always work. So the book discusses a couple of examples, including one from Japan. The Japanese yen was increasing in value compared to the US dollar. This increase in value of the Japanese yen made Japanese goods more expensive, and it affected the amount of export out of Japan. So the Japanese government, the Bank of Japan, intervened to try to prevent the Japanese yen from continuing to appreciate compared to the dollar. And they did that by starting to buy dollars. So the Japanese government started to buy dollars as a way to keep the Japanese yen from appreciating versus the dollar. So again, the Japanese government, in trying to prevent the Japanese yen from increasing in value, the Bank of Japan started buying US dollars and selling the Japanese yen. Obviously, by selling Japanese yen and buying dollars, this is meant, of course, to increase the value of the dollar and decrease the value of the Japanese yen. This strategy, unfortunately for the Japanese government, did not work. So if you see the diagram, you see the exchange rate, the trend is this one. So this is the number of Japanese yen per $1, right? So we are quoting yen per $1. So this decrease means yen appreciation. So obviously, this again makes Japanese goods more expensive, and it affects the Japanese economy in a negative way by making exports out of Japan very expensive. So the Bank of Japan intervened and start selling yen and buying dollars. And you see, when they did it, there is this movement showing that they were able to just briefly prevent the continued yen appreciation. But this movement was very brief, and no long after that, the Japanese yen continued to appreciate versus the dollar. So you note at this point, the exchange rate was this one, $1 equal to 94.71 Japanese yen. By this point, you see the exchange rate is $1 is equal to 80.67 Japanese yen. So the Japanese yen got more and more expensive despite the efforts of the Bank of Japan to prevent that. Another example the book discusses the case of Turkey. In 2014, the Turkish government was trying to prevent the depreciation and the depreciation of the Turkish lira and the capital flight out of Turkey. They did that by trying to increase the domestic interest rate. So the Turkish central bank increased the domestic interest rate, hoping to attract capital into Turkey and keep the value of the Turkish lira from dropping. Unfortunately for them, this strategy did not work. So eventually, capital still left Turkey and the Turkish lira collapsed. The problem for Turkey was the very high increase in the interest rate that they attempted to do end up slowing the economy down and causing a huge domestic problem. So that strategy from the Turkish government simply did not work as intended. Now, obviously, even though these attempts may not work, it is important for market participants to understand the motivations of these currency market interventions. The last thing I wanted to discuss in this chapter are the two sort of crisis. The first one is the Asian crisis of 1997. Just as a brief discussion of the brief explanation of what happened in these economies at the time. So the main explanation for the Asian crisis of 1997 was the transition of many of those countries from being exporters to becoming net importers. So before we continue with this, let's see what that usually means for the country's economy. So if you are a net exporter, if you're a net importer, that means your imports are greater than your exports, right? So of course, this is not too unusual because, for example, this is the case of United States, right? You remember we saw in chapter 3 that the United States is a net importer, for example. Now, what that means, however, is if you are a net import country, so that means your current account is a deficit account, right? So that means there is an outflow of foreign exchange. Now, this outflow of foreign exchange normally leads to your currency depreciation. So that's kind of one thing. But the main question here is, if you import more than you export, well, you will need to support that by attracting capital into your country some other way. So typically what happens then is a country that has a current account deficit will have a capital and financial account surplus. So typically you will have a capital and financial account surplus. In other words, there is an inflow of foreign exchange to invest in the domestic economy. So you import more than you export, you make up for that by attracting foreign investment into your country. So foreigners want to buy your bonds, your stocks, they want to invest in domestic companies, etc., etc. In other words, you need to borrow from foreigners. That's basically the bottom line. You are borrowing from foreigners to pay for this deficit. This again is the case of United States. United States, of course, has a huge surplus in this account. In other words, there is a huge inflow of capital into the United States to buy US government bonds, to invest in the stock market, to invest in American companies, etc., etc. So this inflow here balances the outflow in this account. And while this is happening, the domestic currency is stable, right? The domestic currency is stable because you are attracting capital to foreign exchange capital to make up for the large deficit in the current account. But anytime this happens, the question then is, are you able to pay back that money, right? In fact, even in the case of the United States, occasionally you hear politicians in the US wondering, how are we going to pay for this, right? The huge amount of debt to foreigners, how do we pay for that? Now, the reality is the United States is such the attractive investment market that there is no question that US will continue to attract inflow of capital into the United States. So US does not have an issue continually attracting capital. Now, this is not true for other countries. And so this is basically the case of Thailand. So as Thailand transitioned from net exporter to a net importer, Thailand made up for that by attracting huge amount of capital inflow into Thailand in 96 and 97. Basically, the capital was flowing into Thailand to invest in all sort of assets. Well, eventually, the amount of capital flowing into Thailand was so much, the amount of debt to foreigners became so large that many market participants started to wonder if Thailand was going to be able to repay all that debt. Well, this created the fear that if Thailand is not able to pay all that debt, then a lot of the foreign investors started to take their capital out of Thailand. Now, as they started taking the capital out of Thailand, this put pressure on the currency, Thai currency, down. So this puts downward pressure on the Thai currency to drop. The government intervened in the market, trying to keep the value of the currency from dropping by both buying the domestic currency in the market, and indirectly by raising interest rate in the domestic economy. Well, obviously, when you raise interest rates, as I mentioned previously, this tends to have a negative effect on the economy. It sort of slows down the economy and creates unemployment, etc. So this effort to defend the domestic currency, to prevent this capital outflow, essentially result in a economic crisis, at the same time that it did not, let's say, it did not give investors any more confidence that Thailand was going to be able to pay all that debt. So capital continued to flow out of Thailand. Eventually, the government had no choice but to allow the currency to float, basically to go from a peg exchange rate to a floating exchange rate. But the minute that happened, the value of Thai currency dropped significantly. When that happened, other economies in the area including Malaysia, Indonesia, and the Philippines, follow, and their currencies also came under attack, putting significant pressure on the value of the currency at the same time that the domestic economies started going into a recession. Now, to compound problems in those economies, in addition to the currency issues that we just discussed, those economies also had other problems, including banking instability, corporate socialism, and governance cronyism in the economy. All of those things which complicated, exaggerated the currency crisis in the first place. And the result, of course, was an all-out Asian economic crisis of 1997. So we see the value of the Thai currency. So you look at the line is typically flat initially because it is fixed versus the US dollar initially. Then when the Thai currency came under attack, there was a devaluation of the currency, a kind of a overnight devaluation. The problem is these did not prevent capital outflow, and so once the government decided to let the currency float, the value of the currency continued to drop. So this reflects the depreciation of the currency, Thai currency, right? So again, an example of basically where the government intervention did not help, is simply delay what was eventually going to happen. One more example is the Argentine crisis of 2002. We mentioned Argentina in chapter 2, maybe chapter 3 as well. You remember before 1991, Argentina had a huge problem with inflation, very, very high inflation. And so the government of Argentina fixed the value of the Argentinian peso to the United States dollar at 1-to-1 exchange rate. They did that by adopting a currency board structure. You remember a currency board eliminates inflation, but it also fixes, it is a full commitment to a fixed exchange rate. The problem with the currency board, however, is that the central bank has no ability to stimulate the economy. So this means central bank can't stimulate the economy. Right? So they are not able to promote growth. They are not able to promote employment. Basically, central bank hands are tied. The only priority, the only goal is to keep the exchange rate fixed. The problem is, after a few years of recession, where the Argentinian economy wasn't producing very much, the central bank keeping the peso fixed to the United States dollar meant that basically the government had to spend money on a lot of social welfare programs. Right? The economy is not doing well. The government wants to keep the exchange rate fixed. So the government had to try to bail out the people with large welfare spending programs. Well, the result of all that is the Argentinian peso became highly overvalued compared to the US dollar, right? Essentially, the market wanted the peso to drop in value, but the central bank was keeping it fixed. Well, when the peso is overvalued, that also means that, of course, at the same time that the economy is not generating much in terms of output and growth, the government was running a huge budget deficit, right? So all those things meant that essentially the government could no longer sustain this fixed exchange rate, and so the Argentinian government eventually abandoned the fixed exchange rate in 2002, and the Argentinian peso was devalued. And unfortunately, however, the economic situation essentially lasted a very long time. Basically, all the measures taken by the central bank and the government during that period, that just meant that the economy went into a major contraction. And obviously, Argentina, even today, continues to sort of suffer from a lot of the same issues. And so again, here you see the diagram. So up to this point, the exchange rate is fixed versus the US dollar, and then the government eventually had to abandon the fixed exchange rate, and so you see a devaluation of the peso. So here again, peso depreciation. Okay. Now, so those again are kind of a couple of examples of currency crisis, government intervention in the market, and the chapter continues some discussions about currency forecasting, etc. But again, this is sort of what I wanted to discuss in this chapter so far. To conclude the chapter, I'm going to very quickly solve a simple example from the end of the chapter. This example, question 9.10. So we are told that you have British Petroleum and Rosneft of Russia used to have a joint venture, which they ended in 2013. And when they had ended it in 2013, the deal was Rosneft buying the British Petroleum for 54 billion US dollars in cash and a 20% equity interest in Rosneft. So British Petroleum will receive a 20% equity interest in Rosneft. Now, in order to complete the purchase, Rosneft of Russia borrowed a huge amount of money in order to do this transaction. Now, British Petroleum in 2014, July of 2014, received a dividend on that 20% equity interest. And the dividend amount was 23 billion Russian rubles. Now, the problem is the Russian company had been on the decline at the same time that the Russian ruble had also been fallen. So the company's performance was dropping at the same time that the value of the Russian currency had been declining. Now, to make things worse for the Russian company, they had to make a $19.7 billion payment in 2015 on the amount of money that they had borrowed in order to acquire British Petroleum. So this question is asking if the spot rate in 2014 was 34.77 Russian rubles is equal to $1, how much was the value of the dividend paid in US dollars? Suppose the exchange rate was this one instead, what was the value of the dividend payment? And then part C says, suppose a combination of Western sanctions on Russia and the lower oil prices in the market sent Russian economy into a recession. And the exchange rate is this one. The question is, what will the value of the dividend be in 2015? So problem 9.10. So the spot rate in 2014, we are told is 34.77 Russian rubles is equal to $1 US. And the spot rate in 2015 is 75.03 Russian ruble is equal to $1 US. The dividend amount is 23 billion Russian rubles, right? So A, what is the dividend in dollars? So pretty simple here, of course, nothing unusual here. We just have to convert these $22 billion, 22 billion Russian rubles into dollars. So of course, the exchange rate is 34.77 Russian rubles is equal to $1. So the question is, what is 23 billion Russian rubles then, right? So of course, in dollars, then we just have 23 billion divided by 34.77 Russian rubles is $1. So if we do that, 23 divided by 34.77, so that's 661,489, 790.0 dollars, right? So the amount of dividend in dollars would be 661 million US dollars. For part B, assuming that the exchange rate is instead this one now, so the amount of dividend would be, of course, same 23 billion Russian rubles divided by 75.03 Russian rubles is equal to $1 US. So in dollars, that's 306,544,049.0 US dollars, right? Again, pretty simple. Then part C says basically what would happen to the dividend if as a result of sanctions on Russia economy and the fall of Russian rubles to the new exchange rate is 75.03 Russian ruble to $1. Right, so suppose the exchange rate is this one, and at the same time, as a result of sanctions and lower oil prices, and lower oil prices. So this question is just trying to get you to think about what would happen in practice if, as a result of these sanctions and lower oil prices, what would happen to the dividend? So the Russian company is supposed to pay a dividend of 23 billion Russian rubles, right? Now, obviously, to pay this dividend of 22 billion, the company has to do well enough to generate enough income to pay the dividend. But if, as a result of sanctions and the drop in oil prices globally, the company struggles, for example, right? If the company struggles, well, the company may not generate enough in income to be able to pay the promised $23 billion in dividend. That's the first part. Plus, right, because the Russian economy was struggling, and as a result of sanctions, you can see a case where the Russian government could impose capital controls to prevent capital outflow, right, out of Russia. And if they do that, then the Russian company will not be able to pay the dividend to the British Petroleum. So in other words, the British Petroleum in this case is facing significant risk on this expected dividend payment. If the company struggles as a result of sanctions and high oil prices, then the company may not be able to generate cash to pay. Two, if the Russian government imposes capital control, then of course the Russian company may not be able to pay the dividend as scheduled. And finally, the depreciation of the ruble meant that the value of the dividend could drop from this one, for example, to only this much to the British Petroleum. So this C is trying to get you to think about all the risks that a company like BP may face in the expectation of this dividend from the Russian company, where the dividend is in Russian rubles.